Blood in the vaults. 15% of silver disappears in 24 hours. February 5th, 2026. 3 million ounces of physical silver gone from the vaults in just 24 hours. While in Shanghai, 6 groups of linked accounts were banned for dumping 674 million ounces of paper silver in a single morning session. The same day, CME raised margin requirements for the third time in 10 days, not during a price surge, but during a price fall. Western spot price, $74, Shanghai futures, $99, a $25 gap that shouldn't exist. The vaults are speaking, and what they're saying changes everything we thought we knew about this market. Welcome to Financial Crisis Explained. If you've been watching markets long enough to remember when handshakes meant something, when a man's word was his bond, then you understand why we're here. We don't chase clicks, we examine what matters. Before we proceed with the full analysis, may I ask you to do something? There's a subscribe button below this video. It costs you nothing, but it tells us you value serious economic analysis in a world drowning in noise. Just click it. Simple as that. And tell us in the comments, where in the world are you watching this from? New York, London, Mumbai, Shanghai? Because what's happening in these vaults, it affects all of us. Now, let's examine exactly what disappeared and why it matters to every business decision you'll make in the coming months. On February 5th, 2026, something unusual happened in the registered vaults of the COMEX exchange in New York. 3 million ounces of physical silver were withdrawn in a single 24-hour period. To those unfamiliar with commodity markets, this number might seem abstract, just another data point in an endless stream of market statistics. But to those who understand the architecture of modern precious metals trading, this withdrawal represented something far more significant. It represented 15% of the entire registered inventory disappearing in one day. The COMEX vault system operates on a 2-tier structure. Eligible inventory consists of silver that meets exchange standards but is not available for delivery against futures contracts. Registered inventory, on the other hand, is silver specifically earmarked and available for immediate delivery to contract holders demanding physical settlement. This distinction matters. When silver moves from registered to eligible status, or when it leaves the vaults entirely, it signals a fundamental shift in market participant behavior. It indicates that someone, somewhere, has decided paper promises are no longer sufficient. They want the metal itself. The withdrawal reduced total registered COMEX silver inventory to approximately 400 million ounces. In isolation, this figure might not raise eyebrows. The global silver market processes billions of ounces annually through mining, refining, and industrial consumption. But context transforms data into intelligence. The normal settlement pattern for a COMEX silver futures contracts runs between 1 and 3% physical delivery. The vast majority of contracts are cash settled or rolled forward into future months. This is standard practice in commodity futures markets, a system designed for price discovery and hedging, not necessarily for physical commodity transfer. On this particular day, however, settlement patterns deviated sharply from historical norms. 100% of maturing contracts demanded physical delivery, not 1%, not 3%. Every single contract holder chose metal over cash. This behavioral shift cannot be dismissed as coincidence or random market fluctuation. It represents a calculated decision by institutional participants, a vote of no confidence in paper settlement mechanisms. The price structure that day revealed additional stress fractures in the global silver market architecture. Western spot silver traded at $74 per ounce. In Shanghai, spot prices reached $82. Shanghai silver futures contracts were trading at $99 per ounce, a $25 spread between Western spot and Shanghai futures, an $8 premium for Shanghai physical over Western physical. These gaps violate fundamental principles of efficient market theory. In properly functioning commodity markets, price differentials between geographic regions should remain narrow, limited primarily to transportation costs, insurance, and minor local supply-demand imbalances. $25 spreads suggest something more profound than shipping expenses. They suggest broken arbitrage mechanisms. They suggest capital controls or physical delivery constraints preventing the natural equilibrium process that should eliminate such disparities. When Shanghai traders are willing to pay $99 for silver that theoretically costs $74 in New York, plus perhaps $3 to $5 in shipping and insurance, the rational market participant should immediately exploit this arbitrage opportunity. Buy in New York, ship to Shanghai, collect the difference. Yet the spread persists. This persistence indicates barriers to arbitrage. Either physical silver cannot move freely between markets, or those with the capacity to move it have calculated that current spreads will widen further, making patience more profitable than immediate action. Historical precedent offers guidance here. In 2011, similar vault drainage patterns preceded sustained price appreciation in precious metals markets. In 2020, pandemic-related supply chain disruptions created temporary but severe dislocations between paper and physical silver prices. The current situation bears resemblance to both precedents, but with notable distinctions. The 2011 drainage occurred during a clear bull market in precious metals. The 2020 dislocation was clearly attributable to identifiable supply chain failures and refinery shutdowns. February 2026 presents a different profile. Prices have not entered obvious bull market territory. No major refinery shutdowns have been reported. No pandemic-scale disruption has occurred. Yet the vaults are draining, and simultaneously, on the other side of the Pacific Ocean, Chinese regulators were taking unprecedented enforcement action against silver market participants. The timing was not coincidental. What happened in Shanghai would reveal the other half of this equation, the paper side of a market increasingly divorced from physical reality. The announcement arrived with bureaucratic precision. Shanghai Futures Exchange Official Notice 2026-37, issued February 5th, contained language that commodity traders immediately recognized as extraordinary. 6 groups of linked accounts had been identified. All had exceeded intraday position opening limits on silver contracts. Restricted position opening measures would be imposed immediately. The dry regulatory language concealed a market event of staggering magnitude. In a single morning trading session, 674 million ounces of paper silver had been dumped onto the Shanghai Futures Exchange. To understand the scale, global silver mine production for an entire year typically reaches approximately 850 million ounces. What hit Shanghai's market in one morning represented nearly 80% of annual worldwide mine output. This was not normal trading activity. This was not portfolio rebalancing. This was not gradual position unwinding. This was a coordinated assault on price. The mechanics of such an operation require examination. Position limits exist in commodity futures markets to prevent single entities or coordinated groups from accumulating outsized influence over price discovery. These limits vary by contract month and by whether positions are classified as speculative or hedging in nature. When the Shanghai Futures Exchange publicly announces that 6 groups of linked accounts violated these limits, it confirms what market participants had suspected. Someone with substantial capital had deliberately constructed interconnected positions across multiple accounts to circumvent individual position limit restrictions. The goal was singular: to establish a short position large enough to overwhelm normal market absorption capacity. A short position profits when prices decline. The holder benefits from falling markets. But creating a profitable short position in a thinly traded or supply-constrained market requires more than simply betting on decline. It requires forcing the decline. The method is straightforward in theory. Dump massive quantities of paper contracts onto the market in compressed timeframes. Create the appearance of overwhelming supply. Trigger stop-loss orders from technical traders. Generate algorithmic selling from momentum-following systems. Induce panic among retail participants who interpret selling volume as confirmation of bearish fundamentals. In 674 million ounces, someone had constructed precisely such a mechanism. But markets do not operate in isolation. Actions create reactions. Manipulations invite regulatory response. And in this case, the Shanghai Futures Exchange moved with uncharacteristic speed. The SHF enforcement action carried specific implications. By restricting these accounts from opening new positions, regulators effectively froze their ability to add to short positions or exit through normal trading operations. The linked accounts could close existing positions, but they could not expand or roll them forward into future months. This created a strategic trap. If these entities wanted to exit their enormous short positions, they would need to buy back 674 million ounces of paper silver contracts. But buying pressure on that scale would drive prices upward, eroding or eliminating whatever profit the initial short attack had generated. The regulatory response transformed an offensive market operation into a potential self-destructing mechanism. Meanwhile, price discovery mechanisms were fracturing across global exchanges. The Shanghai premium, the difference between Shanghai physical prices and Western spot prices, had widened to $8 per ounce. This premium tells a critical story. Chinese industrial consumers and investors were willing to pay significantly more for physical silver than their Western counterparts. This premium persists despite China's position as a major silver producer and refiner. It persists despite theoretically open global trade in precious metals. Premiums of this magnitude indicate either severe local supply shortage or capital seeking escape from currency risk, or both. The coordination between the massive paper dump and simultaneous physical vault drainage in New York suggests sophisticated institutional positioning. While Shanghai accounts were flooding the market with paper contracts to suppress price, physical metal was quietly disappearing from COMEX vaults. Sell paper, buy physical, profit from the spread. This strategy only works if paper and physical markets remain sufficiently dislocated, if the traditional arbitrage mechanisms that should force convergence remain broken or constrained. And on February 5th, 2026, those mechanisms were demonstrably broken. The question facing analysts was not whether manipulation had occurred. The Shanghai Futures Exchange had confirmed it through official enforcement action. The question was whether this represented an isolated incident or the opening move in a broader market transformation. Across the Pacific, American regulators were preparing their own response. But their approach would target a different pressure point entirely, one that would squeeze capital rather than restrict positions. The margin requirements were about to change. Most market participants expected calm after the storm. They were wrong. On February 6, 2026, the Chicago Mercantile Exchange issued a notice that defied conventional market logic. Margin requirements for silver futures contracts would increase by 20%, effective immediately after the Friday close. For gold futures, the increase stood at 11%. This marked the third margin adjustment in 10 days, the second increase that week alone. And here is where traditional market analysis breaks down, because CME was raising margin requirements while prices were falling. Standard exchange protocol dictates that margin hikes typically follow sharp price increases. When commodities surge rapidly, exchanges raise the capital required to hold positions in order to protect clearinghouses from default risk. Volatility increases, potential losses expand, margin requirements rise proportionally. This relationship has governed futures markets for decades. But February 2026 presented the inverse scenario. Silver prices had declined from recent peaks. Volatility, while elevated, was moving within established bands. No clearinghouse failures had occurred. No major defaults had materialized. Yet CME was tightening capital requirements, as if responding to runaway bullish momentum. The mechanics require clarification. Futures markets operate on leverage. Traders do not pay full contract value up front. Instead, they post margin, a fraction of total exposure, as performance bond, ensuring they can meet obligations if positions move against them. Initial margin represents the capital required to open a position. Maintenance margin is the minimum level that must be maintained to keep that position open. When maintenance margin is breached, traders receive margin calls demanding additional capital or face force liquidation. CME's announcement pushed silver maintenance margin from 15% to 18%. This seemingly modest adjustment carried multiplicative effects across the market ecosystem. Consider an institutional trading desk holding 100 million ounces in silver futures contracts. At 15% margin, this position required certain capital allocation. At 18%, the same position suddenly demanded 20% more committed capital. 20% more capital for the same exposure. For leveraged funds operating near maximum capacity, this created an immediate crisis. They faced three options: inject fresh capital, reduce position size, or accept forced liquidation. Fresh capital injection during market uncertainty is difficult. Investors hesitate to commit additional funds to positions already underwater. Redemption requests often accelerate during volatile periods, draining available capital rather than replenishing it. Position reduction becomes necessary, but reducing positions in futures markets means closing contracts. For long positions, this means selling. And when multiple large participants simultaneously reduce positions, selling pressure compounds. The cascade effect is predictable. Forced selling drives prices lower. Lower prices trigger additional margin calls for remaining participants. More forced selling follows. The cycle self-reinforces until either prices fall far enough to attract new buyers or position holders exhaust their capital entirely. CME's timing magnified this dynamic. By implementing the third hike in 10 days, the exchange compressed a process that might normally unfold over months into a concentrated time frame. But perhaps most revealing was the cross-market coordination of these events. Shanghai banned 6 groups from opening new positions on February 5th. COMEX vaults drained 3 million ounces the same day. CME announced the third margin hike on February 6th. 3 separate regulatory jurisdictions, 3 distinct enforcement mechanisms, 1 compressed 48-hour window. Coincidence strains credibility. The alternative explanation suggests coordinated policy response to a market condition that regulators across jurisdictions had identified as systemically threatening. If physical shortages were developing beneath a surface layer of paper abundance, if the ratio of paper claims to physical metal had stretched beyond sustainable levels, if a delivery squeeze was building that could cascade into broader commodity market dysfunction, then perhaps these actions represented not opportunistic manipulation, but defensive market structure preservation. Yet defensive actions carry offensive consequences. Margin hikes designed to reduce speculative excess also reduce market liquidity. Fewer participants can afford to maintain positions. Bid-ask spreads widen, price discovery becomes less efficient. The very stability that margin increases seek to protect becomes harder to achieve. Meanwhile, the Shanghai premium continued widening. Western spot silver at $74, Shanghai futures at $99. The spread had grown to $25 despite no apparent physical barriers to arbitrage. This suggests capital controls or delivery constraints more severe than publicly acknowledged. Industrial consumers of silver faced mounting strategic dilemmas. Electronics manufacturers, solar panel producers, medical device companies all depend on reliable silver supply at predictable prices. A $25 spread between major markets introduces radical uncertainty into production planning and cost management. Do they secure physical supply now at elevated prices, or wait for paper and physical markets to reconverge? The margin hikes provided their answer. When exchanges tighten capital requirements during price declines, they signal expectations of continued turbulence. They prepare infrastructure for stress scenarios, not yet visible in headline price movements. The vaults were emptying. Shanghai had banned the short attackers. CME was squeezing capital. But the fundamental question remained unanswered. Why was physical silver disappearing while paper silver flooded markets? The answer lay not in trading strategies or regulatory responses, but in the underlying supply and demand fundamentals that had been quietly shifting for years. Those fundamentals were about to speak louder than any exchange notice or margin requirement. The three simultaneous developments form a pattern that cannot be ignored. Vault drainage, regulatory crackdowns, margin compression. Each event examined independently might appear routine. Markets fluctuate. Regulators enforce rules. Exchanges adjust risk parameters. But independence is illusion. These events occurred within 48 hours across three separate jurisdictions. They targeted different aspects of the same underlying market structure. And they revealed a dislocation between paper claims and physical availability that has been building for years. The vaults are not merely storage facilities. They function as confidence barometers for commodity markets. When registered inventory sits stable or grows, market participants trust that paper contracts represent genuine claims on physical metal. When inventory drains rapidly, that trust erodes. February 2026 marked an erosion event. To understand the implications, one must examine the supply-demand fundamentals that created conditions for this dislocation. Annual global silver mine production averages approximately 850 million ounces. This figure has remained relatively stable over the past decade, despite significant price fluctuations. Silver is predominantly mined as a byproduct of copper, lead, and zinc operations. Primary silver mines constitute less than 30% of total production. This byproduct nature creates supply inelasticity. When silver prices rise, mining companies cannot quickly increase output. The economics of base metal mining drive production decisions, not silver prices alone. Conversely, when silver prices fall, production does not decline proportionally because operations remain profitable on copper or zinc alone. Supply responds slowly, demand does not. Industrial demand for silver has accelerated across multiple sectors. Solar panel manufacturing consumes approximately 140 million ounces annually and growing as renewable energy deployment expands. Electronics production requires silver for conductivity applications. Electric vehicle battery systems utilize silver in expanding quantities. Medical applications depend on silver's antibacterial properties. These industrial uses are not price sensitive in the way investment demand might be. A solar panel manufacturer cannot substitute copper for silver in photovoltaic cells without redesigning fundamental production processes. An electronics company cannot eliminate silver from circuit boards without degrading performance. Industrial consumers must secure supply regardless of price within operational tolerance bands. Investment demand introduces additional complexity. In 2020 and 2021, retail investment in physical silver coins and bars surged, draining available inventory from dealers and mints. Premiums over spot prices reached historical extremes as fabrication capacity struggled to meet demand. That retail surge has moderated, but institutional positioning has evolved differently. Central banks and sovereign wealth funds traditionally focused precious metal reserves on gold. Silver occupied minimal space in official sector portfolios. Recent years have shown tentative shifts in this allocation pattern. Specific Middle Eastern and Asian institutions have reportedly increased silver exposure as diversification against currency risk and inflation hedging. These flows are not publicly reported with the transparency of gold reserve holdings. But vault movements and import-export data provide fragments of the larger picture. Now consider the mathematical reality: 850 million ounces of annual mine production, 140 million ounces consumed by solar alone. Electronics, batteries, medical applications, adding perhaps another 250 million ounces. Investment demand, both retail and institutional, claiming additional hundreds of millions. The numbers suggest structural deficit, more consumption than production. Yet prices remained range-bound for years. How? The answer lies in above-ground stockpiles and recycling flows. Existing inventory, accumulated over decades, has buffered the market against immediate shortages. Industrial recycling recovers perhaps 150 million ounces annually from electronic waste and photographic applications. But buffers are finite. stockpiles deplete. Recycling faces diminishing returns as recovery processes approach maximum efficiency. The geographic price spreads confirm stress in these buffer systems. Shanghai trading $25 above New York indicates Chinese buyers cannot access Western inventory at prices that should make arbitrage irresistible. Either capital controls prevent fund flows necessary for arbitrage transactions, or physical delivery logistics have degraded beyond normal friction levels. Or available, Western inventory is already committed and unavailable for diversion. Each explanation points toward supply constraints. The regulatory responses now appear less as isolated enforcement actions and more as coordinated crisis management. Shanghai banned the accounts flooding markets with paper contracts because regulators recognized that price suppression through unbacked paper creation was destabilizing physical supply chains. CME raised margins because clearinghouse risk models identified potential delivery failures if too many contracts demanded physical settlement simultaneously. The system was approaching structural limits. For business decision makers, these developments demand strategic reassessment across several dimensions. First, supply chain security for industrial silver consumers. Companies dependent on reliable silver inputs should evaluate inventory buffer levels, supplier diversification, and contract structures that guarantee physical delivery rather than cash settlement options. Second, portfolio allocation for institutional investors. The divergence between paper and physical markets creates distinct risk-return profiles. Paper silver exposure through futures or ETFs carries counterparty risk and potential cash settlement in scenarios where physical delivery becomes constrained. Physical holdings eliminate counterparty risk, but introduce storage costs and liquidity constraints. Third, derivatives market counterparty evaluation. The Shanghai enforcement action revealed that large, presumably sophisticated institutional participants had constructed positions violating exchange limits. When such entities face restricted trading or forced unwinding, counterparty risk across the derivatives ecosystem increases. Fourth, monitoring frameworks for ongoing assessment. Several indicators warrant continuous observation. COMEX registered inventory levels and withdrawal patterns. Shanghai premium magnitude and persistence. Margin requirement trajectories across exchanges. Futures curve shape, particularly backwardation versus contango structure. Refinery and mint production capacity utilization rates. Historical precedent offers guidance without determinism. In 2011, silver vault drainage preceded price appreciation from $30 to $48 over several months before correcting sharply. In 1980, the Hunt brothers' attempt to corner silver markets created extreme volatility ending in regulatory intervention and price collapse. February 2026 resembles neither scenario precisely. No obvious corner attempt is underway. No clear speculative mania has gripped retail markets. Instead, what appears to be unfolding is a slower-moving structural transition. A market adapting to the reality that decades of paper abundance may not reflect current physical availability. The vaults are speaking clearly. Physical metal is migrating away from exchange-registered status toward private holdings. Settlement preferences are shifting from cash to delivery. Geographic price spreads are widening despite theoretically open global trade. These signals do not predict specific price levels or timelines. Markets are complex adaptive systems, not deterministic machines. Outcomes depend on policy responses, technological developments, macroeconomic conditions, and participant behavior that cannot be forecast with precision. But the signals do indicate elevated risk of further dislocation between paper and physical silver markets. They suggest that business strategies assuming reliable correlation between futures prices and physical availability require revision. They demonstrate that regulatory authorities across major jurisdictions perceive sufficient market stress to warrant coordinated intervention. The disappeared 15% from COMEX vaults in 24 hours was not an ending. It was a warning. And warnings, when ignored by those responsible for strategic capital allocation and supply chain security, transform into crises that could have been managed, but were not. The vaults have delivered their message. How business leaders respond will determine whether this remains a manageable market adjustment or escalates into something far more disruptive to global industrial and financial systems dependent on functional commodity markets. The next moves belong to those who understand what they have just witnessed.